you for staying with Whoopi. So without further ado, let's shift our focus from investment to our session now, the evolving role of crypto in the derivatives trading market. So the panelists who are joining me today are good friends of ours, and they are among the leading market makers in the industry. So please allow me to present Michael Lin, the founder of Unnoted, Ran Yi, the CEO of Kronos Research, Ivan Grigorev, the BizDev director from Albert Blanc. Yes, right, a big round of applause. All right, so let me kickstart with a question which I believe is the most sought after tip by all the traders. Pay attention, gentlemen. So what are some key market indicators you pay attention to in a volatile environment, and how are you currently hedging your risk? So shall we start with Michael Lin from Unnoted? You may take over the mic.
Sure. So I'm Michael. We are a quantitative trading firm and liquidity provider in the crypto space. And first thing I'll say just about volatility is it's not necessarily a bad thing. And many trading strategies really rely on the strong directional movement in order to make money. So it's kind of only if the movement is extreme, we're talking about jumps or gaps, that really poses a big issue to well-functioning markets. And it's one of the reasons that many traditional exchanges often use market-wide circuit breakers. So, in particular, due to the lack of cross-margin or cross-exchange margin, I should say, it's easy for crypto's traders to be undercapitalized relative to the amount of risk that they're taking on. The popularity of the highly leveraged products, even up to 100x, is not necessarily totally a good thing, given that collateral is also difficult to move around when you need to. So first thing to say is, as a trader, you need to be aware of your own margin risks. And back in March, we remember sort of a massive deleveraging caused by a certain exchange that will not be named here, but not Huobi. And basically, as the price dropped, there was a tremendous amount of liquidations. And so that sort of explosive move and inability to move capital around can quickly, cause big trouble for market neutral strategies. And so that is one thing that we certainly now keep attention to. And the last part, just about hedging risk. I'm sure most traders basically rely heavily on the Delta One derivatives. So at the short term and high frequency space, most of the time you need to hedge in a different venue than where you traded. So it's critical to have access to as many places as possible.
All right, that's a very insightful piece of sharing. Then what about Ran Yi from Kronos Research?
Hi, I'm Ran from Kronos Research. We're a team of 40 plus in Taipei and Shanghai. We specialize in quantitative trading, especially high frequency trading. For us, a lot of the indicators, I would say in the quant world, we rely less on indicators, or we make our own indicators. So we take a lot of raw data like price, volume, order book, and we create indicators or alphas or signals, however you call it, that we would use. So we rely less on packaged sort of indicators, but we also have some lower frequency strategies like arbitrage, like CTA, which is trend following, that relies on some of the more or less known types of indicators, or they're somewhat correlated, such as moving averages. These are some of the simple things that people can rely on. Also, things that indicate some sort of supply and demand shift, like open interest, funding rates even. These are some of the things that goes into consideration, but we don't really rely on too many indicators per se. Thanks.
Understand. So you rely on your own to create the indicators. So, right, the tips given really worth more than a bag of gold, yeah? All right, so let's check out what does Ivan from Albert Blanc have to say.
Yes, hi everyone, I'm Ivan. I've been in high frequency trading for almost 10 years and doing roles of trader and analyst, and now with Albert Blanc for 5 years as a business developer. Our firm trades both traditional and cryptocurrency markets. We're doing high frequency trading and market making. And for the cryptocurrency trading, we mainly use the raw price, which is the most important. We look at the price of Bitcoin from the largest exchanges, both spot and derivatives. We also watch volatility on Bitcoin, which impacts our trading in terms of market regimes and switching between them. For altcoins, we watch the respective altcoin markets plus the Bitcoin, which affects altcoins a lot. And for hedging, we generally try to keep our portfolio market neutral, but we have to keep a large position in altcoins to allow ourselves to trade. So now we have to re-hedge and rebalance in real time, which can be challenging during very high volatility. And also we try to use exchange provided services like margin trading and exchange loans to limit our exposure and in altcoins that we don't want to keep on our books. This is it
All
from
right,
us.
thank you. Right. Wow. So all our panelists, they are pretty open and generous. Yeah. So they have shared all their most valuable pieces to the audience. So to all the audience out there, today is your lucky day. And so, Michael, your firm's philosophy is rooted in the belief that the best opportunities are found in unexpected places. So without fully lifting the veil, can you tell us a little bit about how you identify hidden opportunities in the crypto derivatives market?
Yeah, sure. So from a theoretical point of view, it's helpful to understand why sort of these opportunities exist in the first place. And opportunities are basically inefficiencies in the market that are slowly corrected as information spreads to the market participants and is assimilated by them. So for fundamental trading, you might have better information about an asset that lets you decide its future expected value. For more technical trading, the basic information is usually the same as other participants. So what you really need is different kind of information that comes from, first I would say is, number one, attention to detail, and number two, sort of a deep knowledge of the markets and exchanges that you trade on. One of the big questions that we always ask is, if you find something interesting, you should first start by wondering, why does this inefficiency even exist, right? Should it exist? And if it does, why hasn't anyone cleaned it up? Okay, so at the short-term level, really attention to detail is critical, finding things that other people have missed or overlooked. It turns out that many things look deceptively simple on the surface, but if you dig a little bit deeper, you find that they're not simple things at all. So questions like about how does one measure risk? What is the current price of Bitcoin? Why does the price differ between futures contracts of different expiration time periods? And there's a simple answer to many of these questions, but as you go deeper, it becomes tremendously more complicated. And being able to develop these hypotheses and analyze and quantify and test them is extremely important. So now I'll just say one more concrete thing about finding actual trading opportunities in the derivative space, which is many people are interested in. And I would say first that an important theme in the cryptocurrency space is the rate of change of the markets. Just in terms of new products being added, exchanges changing all the time, growing and decreasing in market share, and so on. And as most traders probably know, these changes dramatically affect the price discovery that happens in the market. So it's extremely important to keep abreast of the changing landscape, sort of and to capture the opportunities, one, while they last, but also to keep up to date in, sort of predicting the future price of Bitcoin.
All right. Thank you, Michael. So I can't agree more on, your philosophy, and I also believe that the greatest business opportunities often stem from the greatest challenges. So the things that actually get in the way. So sometimes existing problem to give rise to the most successful innovations and sales. And right, so after this, up next will be Ran. Having seeded top quantitative trading teams in China in your past role, and what would you say are some of the characteristics of a top quant trading team?
Yeah, sure. So one of our best quants is our co-founder, Mark. He spent 10 plus years at Citadel first, then KCG, and a few other high frequency trading firms. He runs our high frequency trading efforts. So him and Jack are our co-founders who I went to college with at Carnegie Mellon. And Mark is one of these guys who, he did 2 degrees at Carnegie Mellon in 3.5 years, and then also did a master's. So he did all that while I only completed a bachelor's in finance. So, I mean, obviously you have to be very smart to be in the field of quantitative trading, probably from computer science, financial engineering, physics type of background. There is a natural curiosity in people. I think that's quite important because you have to get quite creative in quantitative trading, especially when it's about identifying certain patterns, because it's ultimately about, that's kind of what it's about, whether it's intuitive or if it's through data-driven machine learning type of pattern recognition, right? So that part is very important, being creative. And you also have to be very persistent and driven, because in trading, I mean, it's the fastest sort of feedback, especially high frequency trading, whether you're doing well or not, right? It's because the act of winning or losing money. So any sort of P&L is reflected right off the bat, and you know right away that if you're right or you're wrong. And in high frequency trading, it happens very fast. So you can potentially lose money very fast. So the persistence to excel and to have the drive to compete with others, because these type of strategies are sometimes and oftentimes a zero-sum game. So then it's people who are some of the smartest people in the world trying to outwit each other, whether it's through technology or through algorithms or through some other way, because the capacity is ultimately limited, and all the guys on this panel know that. We hope that the capacity will increase through time, but it's limited in every asset, and the higher frequency you are, the more limited it is. So, so the drive and persistence to excel is very important. And then I think at the end, you also have to be very passionate about what you do, right? I think people who are good at quantitative trading or high frequency or any other type of trading, they have to be very passionate about this thing. It's easy to burn out or to be wiped out in trading. It's very competitive, and it's a lot of emotional turmoil, right? Especially when you're losing money. So from that perspective, the passion to really play it as a sport or as a craft, and not just for the money, I think that's extremely important. And that's the case with every other job, I think. So I mean, so at the end of the day, I just want to put out some of the advertisement. We're hiring at Kronos Research. We have 40 plus people. We're hiring from all over the world, developers and quants. We have the infrastructure. We have the lowest fees. We trade north of $1 billion a day, and we're happy for any new talents to join us. Thanks.
All right, Ryan, thank you for the little advertisement. But you know what? Your sharing somehow keep reminding me about this quote: talent wins games, but teamwork and intelligence wins championship. Yeah, so right. And now, Ivan, it's your turn. So critics of leveraged derivatives products say that it is akin to gambling, but many institutional traders rely on them as part of a larger strategy. So can you share your thought on leveraged products?
Of course. Well, first of all, we as a firm trade leverage products on crypto very actively. We market make on some of them, others we just trade in a high frequency setting, and we think that they are very promising. We look at them very closely because they are currently very liquid, sometimes more liquid than the spot market. There is a wide variety of products. Different exchanges provide different products with different collaterals, different designs. So you can, an investor can pick whatever product they find more suitable for their needs. However, I would suggest keeping in mind the following things. First of all, leverage. We as a firm never take more than a 3x leverage. So even though some exchanges provide up to 100x, I don't recommend using it because you will be liquidated very, very fast. Even our firm, which we think is quite professional, try to lower these leverages considerably, so not to risk it. Well, the second thing is you need to keep in mind how fast you can deposit funds in case you need to add additional margin. Because if you have a big market move and you cannot deposit because your funds are stuck on a slow exchange with slow withdrawals, or just the transaction cannot register on the blockchain, that can be a problem for you. The third thing is that you need to watch for the liquidation policies on the exchanges and their insurance funds. Currently, most exchanges have insurance funds, but you can check their size and also how did they perform in some recent market moves. You can see how exchanges handle it and try to trade only on the exchanges that have large insurance policies and insurance funds. Then you can be protected. And lastly, you need to know your products, because products have slight differences, which is good because you can pick one, but if you don't know, for example, the expirations, how the expirations are handled, how the liquidations are handled, how the interests are paid, then you can have some trouble, again, in case of big moves. So keeping all that in mind, I think leverage products are great. Can be used by anyone.
Right. Thank you so much, Ivan. All right. I would also like to show you my piece here. So my personal opinion is that investment without knowledge could all be deemed as gambling, full stop. And it has been an exceptionally inspiring 20 minutes of my life. And I want to thank Michael, Ren, and Ivan for being with us today. So reluctantly, I would have to call it a day. And so to the audience in front of the screen, to spend 1 hour with us. So should you have any question, proposal, recommendations, opinions, and advice at all, please visit our booth and drop a text there. We'll be more than happy to have them for you. Thank you, and see you when we see you. Thank you very much, everybody.
Okay, goodbye. Goodbye, everyone.
All right, thank you.